Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 15th of April. I'm Daniel Lam, your host for the podcast. In my latest TV interview about chess, the reporter asked me if I ever played bridge. Well, I did in my teenage years, but my bridge partner went abroad, and that was the end of that. Now, bridge, as opposed to chess, does take two to tango. Now, in finance, you do need to look at both sides of the equation in order to analyze currency pairs. Arguably, the highest profile currency pair is euro versus the US dollar. Now, as we talked about in our podcast last Thursday, the US dollar is quite well supported given the series of stronger than expected economic data in the US. Now, how about the euro side of things? Well, a little bit opposite to that in the US actually. At the ECB meeting last Thursday, the ECB reiterated that most measures of underlying inflation were easing, wage growth was moderating, and companies were absorbing the rise in labor cost through lower profits. And most importantly, the following key sentence was added. If the Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission were to further increase its confidence that inflation is converging to the target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. So this new language signals that the ECB is likely to be cutting rates in June and therefore front-running the US Fed. Now, putting two and two together, this is likely to lead to pressure on the euro-dollar currency pair. Technical indicators such as ADX and MACD, they are pointing towards a continuation of the downtrend since the beginning of March. The immediate support is around the 104.50 and 10550 area. Now, the banks are likely to ease credit standards as interest rate declines, and this will stimulate household consumption. But on the other hand, fiscal policy is likely to become a net drag on growth as countries increasingly focus on consolidating their public finances ahead of the reintroduction of EU fiscal rules next year. So therefore, the environment for growth is likely to be somewhat mixed. And so instead of going for European equities, investors should be focusing upon European government bonds. The deeper interest rate cuts from the ECB versus the Fed can translate into higher capital gains for European government bonds. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.